Welcome back to the Deep Dive. Usually when we sit down to record one of these, I have a pretty good idea of the roadmap. We take a stack of articles, some research papers, maybe a book or two, and we try to synthesize it into something actionable.
Right. We find the patterns?
You find the patterns, we keep it light, we keep it educational, and we usually try to find the silver lining. But today, I have to be honest with you. Looking at the stack of documents we've pulled for this session, the vibe is just, it's different. It doesn't feel like we're prepping for a financial podcast. It feels like we're prepping for a trial.
That's a very, very perceptive way to start, because if you treat the source material we have today as just another market update or a hot tip on some investment strategy, you're going to miss the entire point.
Okay.
We aren't analyzing a market trend today. We are effectively opening a forensic file on a crime scene that, according to these sources, is still very, very active.
Forensic file. That sets a heavy tone right out of the gate. And the label on this file, the bid rigging trap.
That's the one.
Now, for the listeners, I want to set the stage here. We are looking at a theory, and I want to be clear. I am approaching this as the skeptic today because some of these claims are massive.
As you should.
But we are looking at a high-conviction theory that suggests the financial system, specifically regarding the silver market, is rigged against the retail trader. And not just rigged in the sense that the big guys have more money, rigged in a way that is mechanical, precise, and automated.
It's not just a theory about unfair advantages, it's a warning about a specific event. We are looking at a convergence of dates specifically leading up to February 27, 2026.
A specific date.
And we are looking at a specific mechanism, a 0.01 second gap in the digital infrastructure of the markets. The premise, the core of this whole file, is that this tiny fraction of time is the wall that separates the people who own reality from the people who own a hallucination.
Okay, owning a hallucination.
Yes.
We are absolutely going to have to unpack that because that is a terrifying concept for anyone checking their brokerage app right now.
It should be.
But before we get into the sci-fi aspects of high-frequency trading, I want to address the elephant in the room. Why now? Why are we talking about February 2026 as this doomsday clock? Usually market crashes are unpredictable. They happen when a bubble bursts. But the sources here are pointing to a specific date on the calendar.
To understand the date, you have to understand the motive. A crime requires a motive, right?
Right.
The motive here isn't just greed, it's survival. The sources reference what they call the debt wall.
The debt wall. Okay, we've touched on this in previous deep dives, specifically around sovereign debt, but remind us why this matters for the silver market of all things.
Think about the global economy right now. I mean, just look around. Governments, corporations, everyone is leveraged to the hilt. Much of that debt was taken out years ago at what? Near zero interest rates.
Free money, basically.
It was free money. But debt matures. It has an expiration date, and a truly massive tranche of global sovereign debt and corporate paper is coming due for refinancing in early 2026.
So they have to pay back the old cheap loans and take out new, expensive ones.
Exactly. But now, interest rates are higher. Money isn't free anymore. It's expensive. This creates a liquidity crisis, a crunch. Everyone needs cash at the exact same time to service these debts.
And when everyone needs cash.
When you have a liquidity crisis, you don't sell what you want to sell. You sell what is liquid. You sell what has a bid. This creates a natural downward pressure on all assets, stocks, bonds, and, yes, precious metals.
Okay, so the smart money, the big banks, the hedge funds, they know this crunch is coming. They can see the calendar. They know the market is naturally going to dip because everyone is scrambling for cash.
They know the dip is coming. But the allegation in this file, the core of the crime, is that they aren't just going to wait for the dip. They're going to weaponize it.
Weaponize it.
They're preparing what these sources call a V-shaped harvest. They plan to use that natural liquidity crunch as camouflage to crash the price of silver artificially low, far, far lower than supply and demand would ever dictate, so they can scoop up the physical assets for pennies on the dollar.
That is the heist.
That is the heist. And to pull it off, they need to control the price. And to control the price, they need to control the mechanism of the market itself.
Which brings us to the digital ghost. I want to start with something tangible for the listener. We can talk about trillions of dollars and debt walls and people's eyes glaze over. It's too abstract.
I agree. Let's bring it home.
The sources describe a phenomenon that I think every single person listening has experienced personally.
The app spin.
The app spin. Exactly. Okay, let me paint the picture. You're sitting there, maybe it's your lunch break, you've got your phone out, you're looking at the charts. Suddenly you see silver Or maybe a mining stock or crypto, whatever your asset of choice is, take a massive dive. It's crashing. Red candles everywhere.
Panic in the streets, blood on the charts.
Right. But you're smart. You've been waiting for this.
Yeah.
You think this is it. This is the sale. You tap the buy button. You're trying to catch that falling knife right at the very bottom.
Yeah.
And then what happens?
The wheel spins.
The little loading circle, it just
Oh.
spins. And spins and spins. Maybe the app freezes entirely. Maybe it logs you out. Maybe it just lags for 5–10 seconds. But it feels like an eternity.
And while you are staring at that spinning wheel, swearing at your phone, wondering if it's your Wi-Fi or your 5G connection, the market is moving. It's moving without you.
And when the screen finally refreshes, when you finally get that order confirmed notification, the price has bounced. You didn't get it at the bottom. You got it on the rebound. You paid 5%, 10% more than you thought you were paying.
You missed the sale. Every time.
Every single time. And I always assume that's just bad luck. Or, maybe the app is just overloaded because everyone is trying to buy at once. It's annoying, but it feels like a technical glitch.
What if I told you it is not a glitch? What if I told you that spinning wheel is a feature, not a bug?
That sounds incredibly paranoid. You're saying the app is programmed to freeze on me. On purpose.
I'm saying the system is designed with a filter. That spinning wheel is the sound of an electronic gatekeeper slamming the door in your face. The premise we are exploring today is that you are being intentionally blocked from the greatest buying opportunities. The system is architected to lock you out for a fraction of a second, just long enough for someone else to eat your lunch.
That is a massive claim.
Yeah.
You are accusing the brokerage platforms, the exchanges, the entire infrastructure of effectively front-running their own users.
We'll get to the how in a moment, the colocation, the latency, the fiber optics. But first, you have to understand the why. Why would they need to lock you out? Why is the system so desperate to prevent you from buying physical silver at a low price?
Because
They don't have enough of it.
because of the inventory illusion. And this brings us to the first major section of our forensic file, the setup. Okay, let's get into the numbers. The source material highlights data from the COMEX. For those who don't know, that's the primary commodities exchange where silver futures are traded. It's where the price of silver is effectively set for the whole world.
Right, the official price. Now, on the COMEX, you have contracts. A contract is a promise. It's a piece of paper or, a digital entry that says, I promise to deliver 5,000 ounces of silver at this date.
5,000 ounces. That's a heavy brick of metal. Let's see, that's roughly 300 pounds.
Correct, a serious amount. Now, looking at the open interest for February 2026, the data points to roughly 150,000 contracts standing for delivery or open on the books.
Let me do the quick math here. 150,000 contracts times 5,000 ounces each. Wow. That is 750 million ounces of silver being promised for delivery.
750 million ounces. To put that in perspective for you, the global mining production for an entire year is roughly 800 to 900 million ounces. So we are talking about nearly an entire year's worth of global supply being represented in these paper contracts on a single exchange.
Okay, that's a lot of paper, a mountain of paper. But surely the COMEX has the metal and the vaults to back it up, right? That's the whole point of an exchange. You can't sell what you don't have. That's fraud.
And that is where the skeptic in you needs to wake up and pay very close attention. Because when you look at the COMEX vault reports, and these are public documents, by the way, you can look them up yourself, you have to look at two categories. There is eligible silver and there is registered silver.
Okay, explain the difference. This is important.
Eligible just means the silver is sitting in the vault. It meets the purity standards, but it might belong to a private investor or a family office or a manufacturer like Tiffany's or Apple. It is not for sale. It is just being stored there.
So it can't be used to satisfy a delivery demand on a contract.
Cannot. It's like a parking garage.
Right.
Just because my car is parked there doesn't mean the garage owner can sell it to you.
Got it. So it's just inventory on site, but not for sale.
Exactly. Then you have registered. Registered silver is the inventory that is actually available. It has a warrant attached to it. It is the only metal that can be delivered to settle a contract. It's the for sale pile.
Okay, so this is the real question. How much registered silver is there compared to those 750 million ounces of paper claims?
The sources indicate that the ratio is critical, and it is shockingly low. The physical vaults are holding barely 13% of that demand in the registered category.
13%.
13% coverage. For every 100 ounces promised on paper, they have 13 ounces of actual metal to deliver.
Okay, hold on. I'm going to push back here. I have to. Is this really a crime? Banks operate on fractional reserves all the time. If I go to my bank today, They don't have all my cash in the vault. They lend it out. They assume that not everyone is going to come in and withdraw their life savings on the same Tuesday.
Right.
Isn't this just how markets work? Why is 13% a crisis?
That is the standard defense. It's efficient markets. Nobody actually takes delivery. And usually you'd be right. In a normal, calm market, 99% of traders are just speculating on price. They don't want 300 pounds of silver delivered to their apartment in Manhattan. They just want the cash profit.
Right. I don't want a truck showing up at my door. I just want to trade the number on the screen.
But remember the debt wall. Remember the crisis we talked about at the beginning. The assumption that nobody takes delivery relies on confidence. It relies on the belief that the system is sound. But what happens when that confidence breaks? What happens when people realize the bread isn't actually there?
The bread voucher analogy.
Yes. We have to use this analogy because it strips away all the financial jargon and exposes the fraud for what it is. It's so simple a child could understand it.
Okay, walk us through it.
Imagine a small town with one grocery store. This store decides to modernize. Instead of selling physical loaves of bread, they sell bread vouchers. You pay $2, you get a ticket. The ticket says valid for one loaf.
Convenient. I can keep it in my wallet. I can even trade it with my neighbor. Hey, I'll give you 2 bread vouchers for your lawnmower. It becomes a form of currency.
Precisely. It's paper bread. It's a derivative. Now, the store manager is a smart guy. He looks at the data. He sees that on any given day, only about 1% of the people with vouchers actually walk into the store and say, "I'm hungry, give me the loaf."
So he sees an opportunity, a way to make more money.
He gets greedy. He thinks, "I don't need to bake a loaf for every voucher. That's inefficient. That's waste. My capital is tied up." So he starts selling more vouchers and more. He sells 400 vouchers, but in the back room, on the shelf, he only has one single loaf of bread.
One loaf, 400 claims.
And as long as the town is happy, as long as the weather is nice and everyone trusts the voucher, the store looks incredibly profitable. He sold $800 worth of vouchers, and his inventory cost was $2. He is a genius. The balance sheet is pristine. That is the silver market today. For every ounce of real physical metal, there are hundreds of paper ounces trading on top of it.
But the math only works as long as nobody checks the pantry.
Exactly. Now, fast forward to February 2026. The debt wall hits. A crisis happens. Rumors start swirling. Maybe a trucking company goes bust. Maybe the flour mill shuts down. Panic sets in. Suddenly, people don't want the voucher. They can't eat the voucher. They want the bread.
The run on the bakery.
Everyone shows up at once. All 400 people, all holding their vouchers, and there's one loaf. The manager is technically bankrupt. He has committed fraud. In a just world, he goes to jail.
But this isn't a just world. This is Wall Street.
Correct. The manager, who is our bullion bank, doesn't panic. He has a plan. He can't bake more bread. You can't just create silver. It has to be mined, refined, shipped. It takes months or years. So instead, he manipulates the perception of value. He plays the manager's ploy.
Okay, what does he do?
He locks the front doors. He turns off the lights. And he puts a giant sign in the window that says, "Special offer. Bread is now worth 1 cent."
Wait, he crashes his own price? Why would he do that?
He crashes the voucher price. He tells the angry crowd outside, "Look, this paper is worthless. The bread market has collapsed. Nobody wants bread anymore. But because I'm a nice guy, I'll buy your vouchers back from you for a penny."
That is psychological warfare.
Oh.
He's creating a panic to get people to sell the claim back to him for nothing. So he never has to deliver the bread he doesn't have.
And it works. You're standing there scared. You see the price dropping on your phone. $2. $1, 50 cents. You think, I better get something out of this before it goes to zero. You sell the voucher back. The manager rips it up. He clears his liability. He keeps the bread.
So when we see silver crash on the charts, specifically during a time of high physical demand, that's the manager putting up the sign.
That's the inventory illusion in action. They smash the paper price to trigger your fear, to trigger your stop-loss orders. They need you to fold your hand because they cannot, under any circumstances, call your bluff.
That explains the crash. It explains the manipulation. But I'm still stuck on the how. You said earlier that I, as the skeptic, should be thinking, if the price crashes, I'm buying.
Right, the rational.
If that manager puts up a sign saying bread is a penny,
Yeah.
I'm not selling my voucher. I'm running around buying every voucher in the crowd. I'll take the whole store for $4. If silver goes to $15, I'm backing up the truck.
And that is exactly what a rational actor would do. And the banks know it. They know there are sharks like you in the water who want to buy the dip. So they have built a mechanism to ensure that when the price hits that penny, You are physically unable to buy it.
This brings us back to the app spin, the spinning wheel.
This brings us to section 2, the mechanism, the 0.01 second latency gap. We need to get technical here for a moment. We need to talk about physics.
Lay it on me.
Where do you think the market actually is? When you visualize the stock market, what do you see in your head?
I guess I see the floor of the NYSE. Guys in blue jackets yelling. Or maybe just servers in the cloud somewhere, an abstraction.
It's not an abstraction. It's servers. Specific servers in specific buildings. For silver futures, we are talking about massive data centers in places like Aurora, Illinois, or Mahwah, New Jersey. Now, imagine you're trading from your home office in, say, California. You press buy.
Okay, my signal goes to my Wi-Fi router.
To the Wi-Fi, to your ISP, to a fiber optic cable, through a series of routers and switches, bouncing across the country for 2,000 miles to reach the exchange in Illinois.
And it travels at the speed of light. It's pretty much instantaneous.
It is not instantaneous, and that is the critical point. Light in a vacuum is fast. Light in a fiber optic cable is about 30% slower due to refraction. And every router it hits, every switch it passes through, adds milliseconds of processing time. That trip California to Illinois might take 15 to 20 milliseconds.
Milliseconds, that's nothing. A blink of an eye is like, what, 300 milliseconds?
To a human, it is nothing. To an algorithm, it is an eternity, an absolute eternity. Now, compare your journey to the banks. They use a practice called Colocation.
I've heard this term. It means they're physically close, right?
It means they rent space for their servers inside the exchange building. They pay millions of dollars a year for a cage, literally a wire cage the size of a closet, to put their server rack right next to the exchange's matching engine.
So my data travels 2,000 miles. Their data travels
10 feet, maybe 20. They are so obsessed with speed that the exchange actually requires all the fiber optic cables inside that colocation room to be exactly the same length down to the inch, so that one bank doesn't have a 3 nanosecond advantage over another bank sitting further away.
That is just insane.
It's the business model. This creates a latency gap. Let's be conservative and say it's roughly 0.01 seconds, 1/100th of a second.
Okay, so they are faster. I get that. But how does that physically stop me from buying the dip?
Because of how the order book works. Let's go back to the crash. The banks crash the price to $50. That's the target. They want to buy at 50. You want to buy at 50.
Right. We both see $50 on the screen and we both hit buy.
No, that's the illusion. You don't see $50 yet. The price hits $50 on the exchange server first. The signal goes out. It reaches the bank server in the next room in, say, 50 nanoseconds. It reaches your phone in California 50 milliseconds later. They are 1,000 times faster.
They see the future.
They see the present. You see the past. In that tiny gap, that ghost window, the bank's high-frequency trading algorithm executes a buy order. They vacuum up all the available liquidity at $50. They buy everything.
So by the time the signal hits my phone, by the time my screen even shows $50.
The cheap silver is gone. The buying pressure from the banks themselves has already pushed the price back up. By the time your app refreshes, the price is $55 or $60.
So I tried to buy at 50, the wheel spun. And when it stopped, my order filled at 60.
You were front run. And if you hit market buy, you just paid 60. You paid the rigged premium. You bought the bounce, not the bottom. Every single.
This makes me absolutely furious because it explains so much. It explains why it feels like the market is always one step ahead of me. It's not a feeling. It's a measurement. It's physics.
You are fighting a sniper with a slingshot. The distance matters, but it gets worse. It's not just that they are faster. They also use illegal techniques like spoofing to create the crash in the first place.
Spoofing? That's placing fake orders, right?
Exactly. Imagine the bank's algorithm places a massive sell order for, say, 10,000 contracts of silver. A huge wall of selling pressure appears on the order book. The market sees that and panics. Oh my God, a whale is dumping. The price drops instantly.
But they don't actually intend to sell.
Of course not. They place the order, let the market react for 50 milliseconds, and then cancel the order before it can be executed. They flashed a fake gun to scare the crowd into a stampede.
This is pure manipulation. It's just lying. It's fraud.
The official term is layering the order book, and they do it thousands of times a second. They drive the price down with fake sell orders and then use their speed advantage to buy the real assets at the bottom they just created.
Okay, stop. Stop right there. I have to put my skeptic hat back on and I have to adjust it very, very tight because everything you just described, colocation advantages, spoofing, front-running client orders, this isn't the Wild West. We have the SEC, we have the CFTC, we have the Dodd-Frank Act, we have laws
We do have laws.
on paper. So how can a bank, a public company, audited, regulated, possibly get away with this in broad daylight? How is this not the biggest scandal on the news every single night? If I rigged a poker game like this, I'd be in handcuffs? Why aren't they?
That is the ultimate question. And the answer is the darkest part of this entire briefing. It's the noir reality check. You have to understand the difference between a fine and a cost.
Explain that.
To you and me, a fine is a punishment. If you get a speeding ticket for $300, it hurts. You feel it. You slow down. You don't want another one.
Right. It's a deterrent. It changes your behavior.
But for a bullion bank, a fine is simply a line item on a spreadsheet. It is a tax-deductible cost of doing business. Let's look at history. This isn't hypothetical. In 2020, JP Chase agreed to pay $920 million in fines to resolve investigations into, guess what?
Spoofing.
Spoofing the precious metals market. $920 million. That sounds like a lot of money. It was a record fine.
It sounds huge. Nearly $1 billion.
But you have to ask the right question. How much money did they make doing it? If I steal $10 billion over a decade of rigging the market, and then I have to pay a $1 billion fine?
Did I lose?
No. You made $9 billion clear profit. It's just a commission.
The fine is just the commission you pay to the government for looking the other way. It's the toll booth. As long as the profit from the harvest outweighs the toll, they will speed through that booth every single day. And they do.
So the regulators are? What, are they complicit? Or are they just overwhelmed? I think it's both. But mostly, they are outgunned. The SEC and CFTC are government agencies. They are working on government budgets, using government computers. They are trying to monitor algorithms that operate in nanoseconds. By the time a regulator pulls the tape to look at a suspicious trade, the money is gone. The crime happened 3 years ago.
It's like trying to catch a Ferrari on a bicycle.
It's like trying to catch a Ferrari by looking at a painting of a road. You aren't even in the same dimension of time.
That is an incredibly cynical worldview.
It's forensic. The source material uses a visual metaphor here, a noir infographic. Imagine the algorithm is this glowing neon green line moving faster than the human eye can track. It's the matrix. And the truth, the real value of your money, is this dull antique gold buried underneath. The banks operate in the dark, in that 0.01 second gap where the regulators are simply too slow and too blind to look.
Okay, so we've established the setup, which is the 150,000 contracts versus the nearly empty vault. We've established the mechanism, the colocation, and the ghost window. And we've established the lack of a sheriff because the fines are just fees.
Correct. The crime scene is set.
Now, we have to talk about the trap, the final act.
The V-shaped exit.
We mentioned this earlier. The crash and the recovery. Walk us through exactly how this plays out in February 2026, according to this file.
Picture the chart in your mind. You see a sharp, violent V-shape.
Okay, I can see it.
The left side of the V is the crash. The debt wall hits. The manager puts up the sign. They spoof the price down. Silver goes from, say, $35 an ounce down to $18 in a matter of hours.
Absolute panic. I mean, retail traders are getting margin calls. Their brokers are forcing them to sell to cover their losses.
Exactly. They are puking their positions at the worst possible time. Then, at the very bottom point of that V, the vertex, that is where the HFT algorithms kick in, that 0.01 second harvest. The vulture in a business suit swoops down. They buy everything. They cover their short positions. They flip long.
They catch the falling knife because they know exactly where the floor is.
Because they built the floor. Then comes the right side of the V. The pump. Once they own all the physical claims, they let the price fly. They stop spoofing. They let reality take over. The price shoots back up. Maybe it goes to $50, maybe $85.
Okay, so here is my question. This is what I'm thinking as a listener. If I just hold on, if I have what they call diamond hands and I don't sell during the panic, I'm fine, right? The price comes back up. My contract is worth $85. I win. I beat them.
And this is the ultimate trap. This is the part that keeps me up at night. This is the force majeure.
Force majeure, that's a legal term. It means act of God.
Or act of exchange. Remember, even if the price on the screen goes back up to $85, the store still only has one loaf of bread. The fundamental shortage hasn't changed. In fact, it's worse, because now everyone who's survived wants delivery.
So what do? They can't deliver.
They invoke the emergency clauses in the contract, specifically Rule 23, or similar disordered market rules. They issue a press release. They say, look at these wild swings. The market crashed to $18 and went to 85 in 2 days. This is chaos. We cannot possibly ensure fair physical delivery in this environment.
They blame the volatility that they created.
Precisely. It's the perfect crime. They declare the market broken and they implement mandatory cash settlement.
Mandatory cash settlement. I need you to explain exactly what that means for the listener holding a contract or an ETF share like SLV.
It means you get an email. The email says, Dear customer, due to unprecedented market conditions, we are closing your silver position. We cannot deliver the metal. However, the closing price on the screen is $85. We have deposited $85 into your account. Have a nice day.
They force me to take the cash. They sell my position without my permission.
Yes.
But isn't that okay? I mean, it's not great, but if the price is 85 and they give me $85, I didn't lose money, I can just take that cash and go buy silver somewhere else.
Oh, can you?
Well,
Why couldn't I?
this is the decoupling. This is the most dangerous moment of the whole event. That $85 is the screen price. It is the price inside the rigged digital casino. But outside, in the real world, in the coin shops, in the private dealer networks.
You mean the street price?
Because there is no bread, the street price is disconnected entirely from the paper price. While the screen says 85, the actual price to get a physical ounce of silver in your hand might be $120 or $150, or more likely, not available at any price.
Oh, wow. I see.
So they hand you 85 fiat dollars. You turn around to buy the metal you thought you owned, and you find out you can't touch it for less than $150. You have lost nearly 50% of your purchasing power instantly in the blink of an eye. They didn't just rob me of money, they robbed me of the asset itself. By forcing me into cash, they essentially kicked me out of the lifeboat and handed me a wad of paper while the ship is sinking.
They legally confiscated your proof of reality, the physical metal, and handed you synthetic debt. And remember, at this point in 2026, the dollar itself is likely under immense pressure because of that very same debt wall. You are left holding the melting ice cube.
That is the heist. It's not stealing the balance in your account. It's stealing your position in the asset class.
Correct. It is a forced liquidation of your wealth insurance, and it is completely legal under the terms of service that nobody ever reads.
Let's talk about those terms of service. You mentioned ETFs earlier. A lot of people listening probably own SLV or similar funds. They think, I own silver.
Read the prospectus. I dare you. Seriously, pull it up tonight. Most of these funds are structured as trusts. And if you read the fine print, there are almost always clauses about cash redemption or force majeure. If the underlying market, the COMEX, declares a force majeure, the ETF can and will do the same.
So the ETF is just a mirror. If the real object breaks, the reflection in the mirror breaks too.
You are holding a photocopy of a claim on a loaf of bread. You are 3 layers removed from the actual nutrition. You have all of the price risk and none of the ownership rights.
This paints a very stark picture of the population. The notes here categorize people into 2 classes going forward, the synthetic class and the verified class.
It's the defining split of the next few years. The synthetic class holds paper, they hold digital numbers on a screen, they trust the app. And because they live in the digital world, they are subject to the digital rules. The latency gaps, the spoofing, the cash settlement.
They're the ones standing outside the grocery store with the vouchers, getting paid pennies on the dollar for their claim.
Exactly. And then you have the verified class. These are the people who hold physical metal. They hold it in their own possession or in private, allocated storage, completely outside of the banking system.
And allocated is the key word there. It means it has their name on it. It's not in a big pool.
Right. Specific bars, specific serial numbers. These people operate in what we call private networks or peer-to-peer markets.
Is that like some underground black market? Is that even legal?
Of course it's legal. It's just private. The technical term is over-the-counter. If I sell you a silver coin for cash, that's a private transaction. When the screen price says $85 but the street price is $120, that $120 transaction is happening in the verified network. It's happening between real people exchanging real value, completely ignoring the official broadcast from the rigged casino.
It's almost like 2 parallel economies. One is the matrix, the neon green code, the HFT algorithms, the politicians, the headlines, and one is the real world, the antique gold, the atoms, the physics.
And that 0.1 second gap is the firewall. It is the mechanism designed to keep the people in the matrix from escaping to the real world with their wealth intact.
So we've gone deep into the problem. And I have to say, My inner skeptic is having a very hard time finding a hole in this logic. The physics of colocation are undeniable. The history of the finds is public record. The shortage of inventory is in the vault reports. It's a compelling and, frankly, terrifying case. But it leaves me feeling pretty helpless. What is the verdict? What does a listener actually do?
The actionable advice from the file is simple, but it requires effort. It requires going analog.
Going analog. I like that.
Stop trusting the digital proxies. Action step 1. Avoid paper silver. If you own an ETF, you need to understand that you do not own silver. You own exposure to the price of silver, and it's subject to massive counterparty risk.
Counterparty risk. That's the fancy term for will the other guy actually pay up when things get ugly?
Exactly. In a physical coin that you hold in your hand, who is your counterparty?
Nobody. I have the coin. Physics is my counterparty.
Exactly. If you hold it, you own it. Action step 2. Build your network now. Do not wait for the crisis in February 2026.
Why not wait? If the crash is coming, shouldn't I wait for the sale?
Because of the premiums. When the panic hits, the spread, that's the difference between the spot price on the screen and the physical price in your hand, will blow out. You might see spot at $20, but dealers will be charging $40. And more importantly, inventory will vanish. You need to have relationships with local dealers or reputable online bullion dealers before the crowd shows up.
You want to be on the Christmas card list of your local coin shop.
You want them to pick up the phone when you call. You want to secure your exit from the digital casino while the doors are still unlocked and the lights are still on.
You know, we talked about that neon green versus antique gold visual earlier.
Yeah.
I want to circle back to that before we close. Because there is a huge psychological element here too, isn't there?
There is. The app spin isn't just a technical barrier, it's a dopamine trigger. The entire financial system has been gamified. It's designed to be addictive. Bright colors, flashing numbers, instant gratification, or instant pain.
It feels like a slot machine in Vegas.
It is a slot machine. That neon green is dopamine. It exploits your impatience. It exploits your greed. The algorithm knows that humans are emotional. We panic. We have fear of missing out. The algorithm has no psychology. It has no fear. It has no greed. It just executes code. It processes data in nanoseconds. When you try to trade against it using your human emotions, you lose. Every single time. It's designed for you to lose.
And antique gold.
Antique gold is boring. It's heavy. It doesn't flash. It sits in a safe. It doesn't give you a dopamine hit every 5 seconds. It requires patience. It requires wisdom. It's the opposite of the casino.
So going analog is also about detoxing from the dopamine of the screen.
It's about realizing that real wealth is boring. Real wealth is quiet. Real wealth is atoms, not digits. The smart money knows this. That's why they're rigging the code to get the atoms.
Yeah.
They want the gold. They want you to have the paper.
That is the ultimate irony. The banks are the biggest proponents of paper trading for the public, while they are quietly hoarding the physical assets for themselves.
Watch what they do, not what they say. Always.
Well, we have certainly opened the file today. We've looked at the math, the tech, the law, and the psychology. It's a lot to process.
It is. But clarity is always better than comfort.
I agree. So, to our listener, the dossier is open. You know about the date, February 2026. You know about the debt wall. You know about the spinning wheel on your phone and what it really means. The question is, are you going to stay in the synthetic class, hoping the manager doesn't lock the door? Or are you going to verify your reality?
In 2026, if you can't touch your wealth, it's just a hallucination on a screen.
A hallucination on a screen. That is going to stick with me. As always, none of this is financial advice. We're just two people reading the files, but it is definitely a call to audit your own life. Check your exposure.
And check your inventory.
Thanks for diving deep with us. This was a heavy one, but an important one. We'll see you on the next briefing. Stay safe out there.
Stay verified.